Hi, and welcome to our Inside Insurance M&A Exploring the Process webinar. This is the first webinar in our three-part series on insurance M&A that'll be coming throughout the year. I'm your host, Jason Gaskell, Vice President Strategic Markets here at Oak Street. And today I'm joined by Chris Hughes, Managing Director of Insurance Distribution at M&A Services. Today we'll cover all aspects of the M&A process, including timelines, potential risks, what buyers and sellers can anticipate, and I'm sure much more. So first of all, Chris, thanks for joining me today.
Yeah, thanks so much, Jason. I appreciate it. Look forward to this webinar and telling you a little bit about the M&A process and how things run.
Well, speaking of which, maybe to start, investment banks run processes, and maybe you can start off by just describing what an M&A process entails.
Yeah, sure. So an M&A process, and we're talking about an owner that's looking to sell their insurance distribution firm. And that can be a retail insurance agency, a wholesale insurance agency, or an MGA or MGU, specialty product distributor. The process is the same for any of them. So there's like three distinct stages. One, there's a preparation stage that takes anywhere from 30 to 45 days. And that's where the investment banker and the owner, maybe the CFO, is gathering financial information. They're gathering operational information. What you're doing is you're putting together, one, the pro forma income statement to come up with a pro forma EBITDA, EBITDA being earnings before interest, taxes, depreciation, and amortization. And you're putting together a valuation. You're putting together the entire pro forma income statement so that the owner can look at it and say, yep, that sounds right. You're putting together different deal structures of what might be attractive for that particular owner to sell their agency. You're developing a fact sheet, a one-page or a two-page anonymous fact sheet, and you're developing what's called a confidential information memorandum, a SIM. All processes develop a SIM. All bankers do this, and that takes anywhere, just depending on how fast the information is given to us, it takes anywhere from 30 to 45 days to put together all of these marketing materials, put together what we think the pro forma income statement looks like, the pro forma EBITDA, what we think the valuation is, and to put together all the marketing documents. That's stage one of the M&A process. Takes 30 to 45 days. Stage two is we come up with a list of prospective investors in a particular project. Some of them are different for MGAs than would be different for retail agencies, right? It just depends who the buyers would be. And we send out all of these 1 or 2 page anonymous fact sheets. Generally, a process can be very small with 3, 4, or 5 buyers that we would approach. Some sellers are looking for a much larger process where we might approach 15 or 20 or even 25 prospective investors. We send out mutual NDAs that get redlined and they go back and forth. That process takes 5 to 10 days to put together all of the NDAs. Once we have an NDA signed by the selling party as well as the potential investor, then we send out the SIM to that prospective investor. Again, that process takes about 10 days to reach everybody, to go back and forth with redlining of the NDAs. Once the prospective investor has a chance to review the SIM, we set up principal meetings. So the decision makers of the buyers, generally that's their chief M&A guy, their CEO and or their CFO, but pretty high level C-suite folks there, meeting with the principals at the seller. And that's definitely the owner. It could be, if they have a president, it could be a CFO. It just depends on how large the agency is and what the selling team looks like. We've put together, though, since COVID, it's been I'd probably say 70% of these meetings are held by Zoom meetings, and then maybe 30% of them are in person. Or if you have a convenient location like New York, you can schedule a lot of in-person meetings, back to back in a convenient location where buyers and sellers get together. Those meetings take place over a course of 2 to 3 weeks. So it takes 1 to 2 weeks to get all the SIMs out. It takes another 2 to 3 weeks to set up all of these meetings. After that, then we solicit letters of intent. Letters of intent are just written offers. Most of the provisions of an LOI, letter of intent, are non-binding. There are a few provisions that are binding, but the goal is to get 3 to 5 of the most relevant letters of intent from prospective investors. That's kind of the end of stage 2, is getting to a letter of intent. The seller will negotiate, the seller and their banker and us will negotiate a signed LOI with one buyer that will enter into an exclusivity period of 60 to 90 days from the signing of the letter of intent. That, concludes stage 2 of the marketing of the M&A process. And then you enter into stage B, which is again another 60 to 90 days of due diligence and contracting. In due diligence, there's a third-party financing team that will put together a quality of earnings. So there's financial diligence. The buyer's attorneys will start doing legal due diligence and also start putting together the key contracts, the largest and biggest, most important one being the purchase agreement. And then there's the, producer agreements, employment agreements, non-competes, non-solicit. There's all these agreements that get put together, first coming from the buyer's counsel, then to be redlined and negotiated with the seller's counsel. At the same time that all of the operational diligence is going on, all of the financial diligence, and all of the HR diligence and looking at salary rosters and things like that. That process takes anywhere from 60 to 90 days. And then toward the end of that, you get to an actual signing and closing. Most of the time that's done virtually. All the attorneys are on the phone. All the principals of the buyer and seller are on the phone. They exchange signatures that were being held in escrow. All the wire transfers goes out to the right parties, and the deal closes. And that's the end of stage 3 of an M&A process, is the actual closing. So from stage 1 to stage 3, it's about a 6-month process.
I think that's probably key for people to understand. I'm sure you and I both run into people that may have a different idea of what that timeline is going to look like, right? They think it might be a little more expedited than that, but really when you break it down stage by stage and what goes into each of them, and the fact that you have multiple parties involved and oftentimes, and that's before you even bring in the financing piece of this. If someone's looking for outside financing, you've got months and months of work that go into this before you're really to that stage where you're now looking for funding.
Yeah, the financing piece, generally, if there's a financing piece that comes into it, that comes in around at the very, very beginning of stage 3. Once we enter to a letter of intent, if the buyer's looking to finance that piece, we usually bring in the bank. We distribute the SIM to the bank at that time. And the bank would have, the 60 to 90 days to do diligence at the same time that the buyer's doing diligence. And it's kind of like a partnership between the bank and the buyer, and also, really with the seller, because while it is a negotiation, everyone's in the same boat rowing to try to get to the finish line. Everyone's trying to get there.
Yeah, I think that 60 to 90 day window probably holds true for us at Oak Street. We oftentimes say, typically our turnaround time, once we have a signed firm sheet in hand, is usually 30 to 45 days. But of course, as well as I do, depending on the diligence that's involved, that may stretch into 60. It may be expedited, but typically, you're in that 30 to 60 day window, more often than not in that 30 to 45 day window. So that's great information from a timing standpoint. Maybe you could touch a little bit on some of the key financials and information that are really going to be needed for this M&A.
Sure. So when we first get an assignment, we put together kind of an initial information request. And it's rather generic. We're looking for like last 4 years or 48 months, hopefully in Excel, income statements. We're looking for a current balance sheet, and then we'll look for a balance sheet at the end of the prior year, just to get a sense of how the balance sheet moves as well. We'll look for revenue, in terms of MGAs or wholesalers, it's projections for the full year that you're in, as well as the following year. So we're sitting here in April of 25, May of 25, we would look for a projection for the full year 25 and maybe for 26. Then we'll look for kind of a comprehensive all-in book of business report that for the full year and the trailing 12 months that shows, it's a huge Excel spreadsheet that shows carriers, clients, shows how much premium, commission, the line of business it is. It can be sliced and diced. It shows the state that they're in. So you can slice it and dice it and create some really neat informational charts of what their business looks like from, a book of business standpoint. We would look for a detailed salary roster. We look for the different IT systems that are utilized, any of the key lease terms or the actual leases of all the locations that are involved. And then some of the legal aspects, we'll look for what is the actual structure. So is it an S Corp, an LLC, or a C Corporation? We'll look for 3 years of their tax returns. The ownership information usually contained in those documents, but a cap table of who owns what within the agency, the states that they're licensed to do business in, the states that they are actually doing businesses in, and then any kind of E&O claims or lawsuits that they've been involved in the past 5 years, or any other material information that they think that's relevant to us that has happened in the past 5 years, positive or negative.
Yeah, that's great. It's funny how similar your required documents align with ours. I mean, we're the same thing. We're looking for 3 years, last 2 years business tax returns, last 3 years financial statements to include year-end P&L and balance sheets, year-to-date P&L and balance sheet, cap table, personal financial statement for anyone who may be a guarantor on the note, book of business report with premium commissions, carrier lots. I mean, it's very much aligned with exactly where it sounds like you are in the same sort of process. So maybe now obviously we've got the base, we've got the starting point, we've got kind of walking through the timeline and the different stages. We've got some of the actual documentation that we need and the due diligence. Maybe we can cover some of the logistics of the process. What are some of the key risks when you're working through one of these type of deals, Chris?
So there are key risks in every deal, and every business looks a little bit different. So I would say that the ones that pop up most there's key carrier risk. So there's product risk, especially with MGAs that have a program that has one carrier that's doing that program. And if it's running hot, but by hot, I mean running at over 100% combined ratio, right?
Right.
That carrier may not want to continue to write that program indefinitely and not, write profitable business. And it would be hard to take a business that has a history of writing over 100% loss ratio to convince another carrier that, hey, why don't you take over this program? So there's key carrier risk. There could be key client risk, and this happens a lot with, smaller commercial agencies that happen to have one or two large middle market type clients. And you can see where one client makes up 20 or 25% of the entire revenue of a retail insurance agency. And I've seen it in diligence where that client decides to go another way, or that client goes bankrupt, but the business goes away. So the $5 million revenue agency becomes a $3.7 million revenue agency in the middle of diligence. Now you're 4 months, 5 months into a process, you see the closing right in front of you, and all of a sudden you lose 25% of your revenue, and the buyer's like, hey, your business isn't, and the bank, right, isn't what it was a month ago. So we have to reprice the deal. So we see that as a key risk. You also have key producer risk. Some businesses, you might have 3 or 4 producers, and all of them are large producers. You have an owner, maybe it's an absentee owner, maybe it's an owner operator, but you have 3 producers that are producing all of the revenue for that business. And if one of them decides not to come with the deal, one of them, there's just like key man risk, I guess, is a way to say it. Anything can happen. So it's really concentration risk, and whether it's product and carrier, whether it's client concentration, or whether it's key man or producer concentration risk. Those are the things that are the biggest risk of a deal, I think, going forward. We do have some buyers that are not financially healthy. So they're out there looking for financing and they're trying to combine the deals. Generally, we don't see that too often. Most of the investors that we deal with are pretty financially sound, and their banking partners are very sound as well. So we don't see that as much.
It begs the question a little bit. Those are all, obviously key indicators that may or may not move the numbers when you're crunching them. But what happens when you get multiple LOIs? Can Can you talk a little bit about how you work through with some of your clients on evaluating if you have multiple LOIs come in and trying to figure out what's the best fit, what's the best price? I mean, it's not always just about dollars, right? It's about culture. It's about the cohesiveness of the sale. So maybe you could talk a little bit about that. I mean, that's kind of a good problem to have, right? Multiple LOIs. Now we got to figure out which one is the best one.
Exactly right. So in general, in running a process like this, our objective is to get 3 to 5 most relevant LOIs offers from the most relevant buyers out there that value the business the most. In general, in running a process, we may have one outlier that bids 10 to 15% higher than everybody else because they can see the value in that business more than the other buyers. And then generally you have 2 or 3 buyers that are like at market. And then you might have 1 or 2 bidders that are not as relevant with their valuation and their deal structure. But in evaluating LOIs, we put together a nice little presentation for our client that shows on a chart, hey, here's how much consideration there is at closing. Here's how much is part of an earnout. Here's how much is in buyer's equity, or here's how much equity that you could retain as part of a deal. And we try to put it as close as we can on an apples to apples basis so that someone can see, on a table, hey, this is what the financials look like. But let's assume all the financials are within, 3 or 4% of one another. And it's not all about the numbers. So then you start talking to the seller about, well, this company's offering you equity. This is how long they've been in business. This is who their equity partner is and how long they've held them. This is when they're likely to change hands. Or this is what they bring to the table in terms of additional product. This is what they bring to the table in terms of additional distribution for you, or whatever the pluses and minuses are. You get a little bit more of the qualitative factor. And then you get into some of the cultural fit, like you said. So AJ Gallagher, I've been to their corporate offices a number of times. And let me tell you, the company bleeds AJ Gallagher, right? They really have a super tight-knit culture that really believes in the company. But it's a little bit more corporate. So you have a lot of entrepreneurs that have built their own business, and going into a corporate structure can be a little bit difficult for some of those personalities. So you get into more of the cultural fit. Will AJ Gallagher fit with you? Will they fit with your clients? Or do you think you're better with more of a much more entrepreneurial firm that would leave you alone, like say a World Insurance or a Hill Group that's more aggregating, but a lot more hands-off and not so much the corporate culture of a publicly traded company?
Yeah, that's great. I mean, it's interesting because we also look at those types of aspects of a deal, because even though we're underwriting a deal in the moment, we really want to make sure that this is a long-term success, right? We're going to have potentially a 10-year amortization on this loan, that we want to make sure that the two different cultures bind well together, and that post-close that there's not going to be maybe a discrepancy that causes things to fall apart. So you talked a little bit in that about the structure and the different ways, you may look at these LOIs and how a seller may have retained equity or whatever the case may be. Maybe you can touch just briefly on some of the common deal structures and what those look like.
Sure. So common deal structure has definitely closing consideration. What happened? What do you get at closing? And that can be definitely cash, right? So cash is king in all deals. Everyone will tell you all the reason they're selling, but let me tell you, cash is the biggest reason that someone's selling.
Right.
So you have cash at closing. You have stock at closing, and that can be retained equity in your own company, or more likely, it's some offering of the buyer's equity. So with World or the Hill Group, that can be anywhere from 5 or 10% of the purchase price closing consideration in stock, and the rest of it cash, all the way up to 25 or 30% on the high end of that of buyer's equity at closing. The publicly traded companies, they might give you 50%, 60% cash, and the rest of it publicly traded stock, whether it's Brown and Brown or AJ Gallagher or somebody like that. But since they're publicly traded, their stock is just like cash. You can sell it the very next day without any consequence there. So you have closing consideration. Almost every deal I've seen has some kind of earnout component to it. And earnout components can be a multiple of the average of the forward 2 years of EBITDA. It can be a true up at the end of year one, and then a 3-year earnout past that. It can be a earnout that starts, any growth over a hurdle rate of let's say 5% every year. So if you start with revenue of 5 million, you grow at 5%, any amount of net revenue over that 5%, we're going to give you some multiple of that at the end of year one. Then it resets. It happens again in year two, then resets, and then at the end of year three, and then resets. So you have generally earnouts are 2 to 3 year periods. I mentioned buyer's equity or retained seller's equity. That retained seller's equity often has pre-built, terms and conditions. Hey, you can, at the end of year three, you can sell at this multiple. It can be a sliding scale of the multiple. If the business grows, it can be higher. If it shrinks, it can be lower. So there's, downside protections as well as upside potential there. But earnouts are definitely a part of it. And closing considerations. That's really it.
Yeah. Well, and I've heard you mention a few of the big buyers out there. Who are the common buyers in this insurance distribution space?
So in the insurance distribution space, let's just talk about retail agencies. You have the private strategic buyers, most of them backed by private equity, your Acquisures, your World, Choice Financial, the Hill Group, Hub, Risk Strategies, King Insurance. I mean, there's a number of them. If you look at the top 50 largest insurance brokers, there are 40 of them, right? Then you have your public brokers. You have your Brown & Browns, your Aons, your AJ Gallagher, RT Specialties, Marsh McLellan Agency. And then you have pure play private equity. For larger deals, a minimum of, say, 5 million in EBITDA, more likely 10 million in EBITDA. So pretty large selling firms will attract pure play private equity. And those would be your GTCRs, CIBC, Ultimate Capital, White Mountains, more recently BV Investments, BHMS. BHMS owns InsureZone. They own King Insurance. Avery Partners. These are all pure play private equity groups that already have experience in or already holding platform insurance distribution firms as we speak. But for a $10 million EBITDA firm, it could attract them as well. And then you have another category for specialty MGAs primarily, but sometimes you'll have retail agencies that have a real niche specialty and you'll attract carriers. So AmTrust, Global Indemnity, Tokyo Marine, Accelerant, Palomar, just a few of the specialty carriers that can say, hey, you're writing $100 million of premium in the specialty little niche here. We know that niche really well. We're not afraid to own distribution as well. So you have 4 categories. You have your strategics I mentioned, a handful of public brokers, pure play private equity, and then depending on the deal, you could have a number of specialty carriers that would be buyers as well.
Yeah.
And every process is different. Yeah, every process is different, and we try to tailor the process, the size of the process, and who the investors are for each specific deal.
Yeah. Lots of buyers for lots of different aspects of the entire. There's a big picture out there, right? And there seems to be buyers for any aspect of that.
There sure are. There sure are.
So I think one last thing maybe to touch on today as we work through the M&A process, and we may have discussed it a little bit, but there are certainly contracts that go into the deals, right? Can you maybe just touch on some of the main contracts for us moving forward?
Yeah, I sure will. So, and our third webinar of this series, Jason, we're going to go in depth into the diligence and contracts. So each one of these, I'm going to
just a tease, Chris.
Yeah, you bet. So there's the purchase agreement, and depending on the type of deal it is, most deals are asset purchase agreements because the buyer is able to depreciate the assets over a 15-year period. But there can be stock purchase agreements. It's a LLC, maybe a membership interest purchase agreement. So there's the purchase agreement itself. There's the schedules that go into the purchase agreement, which are much more tedious and time consuming to put together than the actual purchase agreement itself. There are employment agreements for all the employees. There's producer agreements for the key producers. And then there's executive employment contracts for the sellers and the executives that are coming along with the deal. There's non-competes and or non-solicit agreements. And then you have a number of ancillary docs, which would be like a bill of sale, assignment of contracts, lease agreements, things like that. So there's kind of 4 categories. There's the purchase agreement, the schedules, the employment agreements or producer agreements, non-competes, non-solicits, and then for all the ancillary docs, the biggest one being assignments of key contracts, assignments of key carrier contracts, assignments of leases or new lease agreements.
Yeah, that's great. And obviously we can get more in depth on that in some of our future episodes. But Chris, I mean, I want to thank you for being here with me today. It's really, it's always great to have your insight. And I know our audience really appreciates you sharing it with us and clearing up some of those questions that I'm sure loom over a lot of people's heads. And thank you to those of you who tuned in and submitted questions today. We appreciate your continued viewership. And stay tuned for more of us here at Oak Street Funding, and look for the second webinar in our Inside Insurance M&A series coming this September. Thanks again.